Did you know that over 80% of hedge funds fail to beat the market? That's right. Despite the hype surrounding hedge funds, most of them deliver lackluster returns. It's shocking, but many investors still pour their money into these complex funds, thinking they're making a smart choice. Hedge funds often boast about their genius managers and exclusive strategies, but the reality is different. In fact, studies show that hedge funds have underperformed simple index funds over the last decade. Who wouldn't want to invest in something that's proven to work? Yet, the allure of fancy jargon and flashy marketing keeps many people hooked. So, why do hedge funds keep attracting investors? This video will uncover the truth behind hedge funds and explain why they might not be the best choice for your money. We'll explore the myths of genius investors, the hidden risks that are rarely discussed, and the real reasons why most hedge funds underperform. Get ready to discover where smart money really goes and why sometimes simpler is better. Let's dive in. Chapter 1. The Myth of the Genius Investor. Why hedge funds play a different game for years. Hedge funds have been seen as the playground of investment geniuses. The truth? They're playing a different game. The average investor believes hedge funds are filled with brilliant minds making sophisticated moves, but that's not always the case. A lot of hedge fund strategies rely less on genius and more on financial engineering. For example, many hedge funds use leverage to amplify returns. While that sounds smart, it's incredibly risky. Leverage means borrowing money to invest, and when markets go bad, losses multiply just as fast. One interesting statistic is that between 2011 and 2020, the average hedge fund returned just 5.6% per year, compared to the 13.6% return of the S&P 500. That's a big gap, especially for a group of people considered the best investors. One reason is that hedge funds often focus on short-term, high-risk trades. Warren Buffett, one of the most successful long-term investors, once said, "If you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. Hedge funds often go for the 10 minutes. This doesn't mean hedge funds aren't skilled, they are. But they're not always aiming to beat the market like everyday investors might think. Many hedge funds focus on absolute returns, meaning they try to make a profit regardless of how the market performs. This approach often involves complex strategies like arbitrage, derivatives, or short selling. These tactics can make hedge funds seem smarter, but in reality, they're just playing by different rules. The goal isn't always to grow wealth like a regular investor, it's often to protect it from losses. That's a big difference. Chapter 2. The hidden risks no one tells you about hedge funds. Hedge funds might seem like a safe bet for the wealthy, but there are some serious risks that get swept under the rug. First, fees are a killer. Hedge funds usually follow a 2 and 20 inches structure, meaning they charge 2% of the assets they manage and take 20% of any profits. That's steep compared to an index fund, which might charge less than 0.1% in fees. Over time, these fees eat into profits in a big way. Another risk is leverage, as mentioned earlier. Hedge funds use it to magnify returns, but it also magnifies losses. During the 2008 financial crisis, many hedge funds lost billions because they were over-leveraged. A famous example is the collapse of long-term capital management, LTCM, in 1998. They were using so much leverage that when their trades went south, it nearly caused a global financial crisis. LTCM lost $4.6 billion in less than 4 months. Then there's liquidity risk. Hedge funds often invest in assets that are hard to sell quickly. This means if there's a market crash or a rush of investors wanting their money back, hedge funds can't always pay out immediately. That's a nightmare scenario for anyone expecting quick access to their money. It's not unusual for hedge funds to lock up investor money for years, with no guarantee of consistent returns. And let's not forget regulation. Hedge funds are less regulated than other investment vehicles, which might sound appealing until things go wrong. Less oversight means more room for errors or fraud. In fact, according to the SEC, hedge fund fraud is a growing concern, with billions lost in fraudulent schemes over the last decade. That's a massive red flag for anyone thinking of jumping in without fully understanding the risks. Chapter 3. Hedge fund hype versus reality. Why most underperform. The hype around hedge funds often makes people believe they're the golden ticket to wealth. The reality is, most hedge funds underperform. Research shows that over a 10-year period, more than 80% of hedge funds failed to beat a simple S&P 500 index fund. Think about that. Something as straightforward as buying and holding an index fund outperforms the majority of these so-called elite funds. Hedge fund managers often claim they're worth the high fees because they have access to special information or strategies. But in practice, many of them can't consistently deliver better results than a basic, low-cost index fund. A great quote that hits this point comes from famed investor John Bogle: "Don't look for the needle in the haystack. Just buy the haystack." In other words, the complexity and hype behind hedge funds can distract from simple, effective investing strategies. One major issue is that hedge funds are often constrained by their size. As they grow, it becomes harder to find enough good investment opportunities that move the needle. Imagine trying to steer a small boat versus a giant ship. The larger the fund, the harder it is to make quick, nimble moves. This is one reason why many hedge funds end up placing large, conservative bets that don't generate high returns. Another problem is that hedge funds don't necessarily prioritize their clients' best interests. Managers often have an incentive to take bigger risks because of how they're compensated. If they win, they take 20% of the profits, but if they lose, it's mostly the client's money on the line. This can lead to reckless bets that don't pan out. At the end of the day, hedge funds aren't magic. They may dazzle with complicated strategies and high-profile managers, but most of the time, simpler investments perform better. And they don't come with the hefty price tag or the sleepless nights worrying about hidden risks. If you're thinking of investing, always ask yourself, is the complexity really worth it? If you're finding this information valuable, please subscribe for more insights into investing and finance. Chapter 4. The Power of Smoke and Mirrors. How hedge funds sell themselves. Hedge funds know how to sell themselves really well. They thrive on mystique, exclusivity, and promises of high returns. It's no coincidence that hedge funds are often pitched as something only the ultra-wealthy can access. This exclusivity makes people feel like they're joining an elite club, but the truth is, most of the magic is in the marketing, not the results. One common trick hedge funds use is to emphasize their private nature. Since they cater only to accredited investors, hedge funds can maintain an aura of secrecy, which adds to their appeal. The idea is that only those with inside knowledge get in, making it seem like a smarter, more informed choice. But in reality, this is more about branding than actual performance. A 2021 study by Prekin revealed that nearly 40% of hedge funds still underperform traditional market indexes, despite their flashy image. One of the reasons people keep investing is because hedge funds sell the dream of beating the market. Hedge fund managers often highlight their best years or specific wins while downplaying losses. It's selective storytelling at its finest. Moreover, hedge funds love to talk about hedging risk, but many of their strategies involve taking on more risk than most people realize. They might engage in complex tactics like long-short equity, where they bet on certain stocks going up while betting others will go down. It sounds smart, but it's a high-stakes game that can easily backfire. This is where the smoke and mirrors really come into play, focusing on the strategy's sophistication rather than its actual effectiveness. They also use jargon and financial buzzwords to keep clients feeling like they're part of something too complicated for the average person to understand. Phrases like alpha generation or market-neutral strategies make hedge funds seem incredibly advanced. But as Michael Lewis, author of The Big Short, famously said, the simplest investment ideas often work the best. Chapter 5. The Wealthy versus the Smart. Why being rich doesn't equal investment savvy. It's a common misconception that rich people are automatically good investors. Just because someone has money doesn't mean they're making the smartest investment choices. In fact, many wealthy individuals fall into the trap of thinking hedge funds are a sure path to even greater riches. But wealth doesn't always equate to financial savvy. One of the reasons wealthy people gravitate toward hedge funds is exclusivity. It feels prestigious to be part of something only the rich can access. But this often leads to poor decision-making. According to a study by Stanford University, 60% of investors in hedge funds said they chose to invest because of the fund's exclusivity, not because of its performance history. That's a clear sign that people are often swayed by status rather than strategy. Hedge funds cater to this mentality by offering tailored services and the illusion of personalized attention. However, it's not always about providing better results, it's about making clients feel special. This can cause investors to overlook important factors, like the actual returns they're getting. Interestingly, some of the smartest investors, those who consistently build wealth, choose simpler, more transparent strategies. Take Ray Dalio, founder of Bridgewater Associates, who recommends a diversified, low-cost portfolio as the best way to build long-term wealth. He believes in reducing complexity, stating, "He who lives by the crystal ball will eat shattered glass." Yet, many wealthy investors go the opposite route, believing that more complicated strategies must be better. The truth is, most of the world's wealthiest and most successful investors, think Warren Buffett, Charlie Munger, and Jack Bogle, advocate for simplicity. They avoid high fees, complex strategies, and the allure of exclusivity in favor of tried and true methods that deliver consistent results over time. Being smart with money often means doing less, not more. If you enjoyed this video, don't forget to subscribe for more insights on investing and finance. Let's make smart money moves together.